Let's bring in the market panel. Joining us is Citi U.S. equity strategist Scott Chronert and Strategic Wealth Capital founder Adrianne Yamaki. Adrianne, consumer staples, utilities, consumer discretionary, the worst performing sectors in the S&P today. Is this just probably a garden variety pullback after days and days of gains, or does it make you rethink anything at all? Adrianne?
So it's interesting because when we look at the broader market, and there's been, notwithstanding today, since the FOMC meeting a week ago, there's been a very, very big, the markets have reacted extremely well, which makes sense. The Fed kept key rates the same, and next year is potentially going to be raising them about 75 basis points. So this puts a lot of money in consumers' pockets. Businesses can borrow a lot more cheaply, and earnings should benefit across the board from it. And if we look at specific sectors of the economy and what's done well, so there's a lot of talk and a lot of analysis these days in the Magnificent Seven, and the tech sector is up about 50% for the year. Financial services and a lot of non-discretionary sectors have not performed as well. However, if we think forward to next year and what it means for interest rates, different companies, different sectors have very different balance sheets, different dependence on borrowing, and therefore very different earning sensitivity to interest rates. So I think what we'll see is a big broadening of marketplace growth, of the stock market growth, instead of it being concentrated in one sector and specifically being a very narrow band of performance in half a dozen stocks. I do think that the lower interest rates will benefit many, many different industries and many different sectors. So the broadening will be quite healthy.
Scott, you feel like the S&P equities in general can continue to move higher in 2024. Are there particular sectors you think are going to lead that? Is it going to take breadth for that to continue?
Well, yeah, so I think the way we're suggesting positioning is that no doubt, as mentioned earlier, you've had this big seven, mega cap growth leadership this year. We're of the page as well that we look for a broadening effect next year. We're suggesting a barbell between growth and cyclical. So essentially, the cyclical element is what we think ultimately should benefit, shorter term from increasing confidence of a Fed pivot that comes with on the heels of some of the interest rate declines we've seen of late. So broadening, yes, is a key message. But again, what we'd point to is that this run that we've just experienced since the end of October has taken valuations on the S&P, past where we thought they would end the year. We were looking for 4,600 for the end of the year. So we think we're living on a little bit of shorter term borrowed time. But as we go into next year, we're still looking for this broadening in response to a more concrete set of earnings growth dynamics across sectors that we think lifts the index higher over the course of the year.
Okay. And of course, the S&P falling back below 4,700 in the close today, 4698, down almost 1.5%. Adrianne, is there the only thing that's been as fast as the run up that we saw in Treasury yields this year has been the subsequent reversal? Is there a point at which falling yields is no longer good for stocks?
I think it very much depends on specific companies and specific industries. If we look at, for example, the broader classes such as fixed income, interest rates declining is going to be good more or less across the board for asset classes, specifically even for fixed income. So right now, there's a lot of money that's been sitting in cash, which makes sense if we look at Treasury bills yielding 5% CD rates. But as that's going to change next year, it helps fixed income because going out further in maturities locks in a higher rate. So normally going out further, you're paid more anyway because you take the longer risk, you have less liquidity. But now there's an additional aspect to it, which is if you can get a 5% in let's say bonds going out between 2 and 5 years, and you lock that in for that period, when rates fall, you'll be in a better position than if you're holding a 6-month T-bill with the same yield, but that matures, and you're probably not likely to be able to reinvest it at the same yield.